I get this question quite often. Hey Arjo, why does my entry fail? My answer is, it's the PD rate that you use the entry in. Let me explain. We need to understand that our entry and our entry confirmation is going to change based on the PD rate that we are looking to confirm. Because the PD rate that we are looking to confirm is always going to be different. For example, if the market was always identical and we always had two fair value gaps that are the exact same as the other one, then we could use the exact same entry confirmation all the time. But that's not the case, because one fair value gap might be higher probability than the other fair value gap. So if that's a daily fair value gap that we are looking to confirm on the lower time frame, then that already means that the higher probability fair value gap needs less confirmation and the lower probability fair value gap needs more confirmation on the lower time frame. So that leads to the understanding that the entries change based on how much confirmation we need. So how much confirmation do you actually need? Well, there's two steps to it. The first one is candle signs and the second one is confirmation. Now, before diving into step one, let me give you some context. This all starts with the understanding of the other side of the market. What do I mean with that? When I do my analysis, it helps to see the market from both sides and not just the side that I want to see play out. For example, I open a chart and I already know I want to see bullish price action. But I still ask myself the question, well, what would need to happen right there if we were actually going to become bearish? If I don't do that, I am going to be so fixated on one side of the market and I'm going to essentially marry a bias and I'm going to ignore and be blindsided by all the bad signs that we might have in price action. The signs that tell us, hey, we're actually not going higher, we're going to continue lower. So what are some of these signs? And that leads us to the first step, candle signs. And in this first step, the main question is there a reason for price to do something else than what we initially expected? Now, this is going to be determined by two things, candle signs and fair value gaps. But before we dive into those two things, we first need to have, of course, the PD rate that we potentially want to confirm on the lower time frame. So in this example, I have used this 4-hour fair value gap right there, which we can go ahead and confirm on the lower time frame. But how much confirmation do we actually need? Well, if we are bullish and we are expecting higher price off of this 4-hour fair value gap, then the amount of confirmation we are going to need is first determined by, do we have a bearish sign? Which is where the first thing comes in. And that was again, candle signs. We can start looking at those signs that we might want extra confirmation, which is where candle signs comes in. We want more confirmation off of a PD rate on the lower time frame if candle signs is respecting an opposing PD rate on the same time frame or above. So let me break that down. So from that sentence, let's first break down that opposing PD rate part right there. What's an opposing PD rate? Well, that depends on the trend. Because if we are bullish and we are trading off a discount array right there, we are expecting higher price of a bullish fair value gap. That means that all the premium arrays, so bearish fair value gaps, bearish order blocks, swing highs, are our opposing PD rays. So if we were to flip that around and we were having a bearish trend, then the opposing PD rays would be discount arrays. So think of bullish order blocks, bullish breakup blocks, bullish fair value gaps, swing lows. Now we want those opposing PD rays to be unmitigated, meaning that they have not been traded into before. So for example, this swing high right there has not been traded above before. That means that that's a valid opposing PD ray. If we zoom out a little bit and we take a look at this 4-hour fair value gap towards the left, this 4-hour fair value gap right there has already been traded into once right there. So the second time we trade into it, it's not valid anymore because it's already been mitigated. So it's not an unmitigated opposing PD ray. Now, please pay attention to that unmitigated or mitigated opposing PD ray detail because otherwise you lose a lot of accuracy. For example, we are reacting right here off the swing high, not the fair value gap right there. That's very important to understand. All right, so we have the opposing PD ray right there. Now, there was a lot more in that sentence because we mentioned same time frame or above, which is quite simple, right? Quite straightforward. That swing high is on the 4-hour time frame right there. The same time frame as the PD ray that we expect higher prices from. So we're not going into the 1 hour or into the 15-minute to find those opposing PD rays. No, opposing PD rays, we want to find them on the same time frame as the PD ray that we are looking to trade off of or above. So the 4-hour can still have a daily opposing PD ray or a weekly opposing PD ray. That's fine. All right, so now we only need to understand the beginning of the sentence because what is respecting an opposing PD array based on candle signs? Well, in candle signs, you can do either one of two things. We are either respecting or disrespecting. And candle signs is all seen through a singular candle. So we only look at a singular candle right there. And when we are respecting a premium array like this swing high, for example, we are wicking that premium array right there with a long wick at the top right there and not closing above the premium array. That's quite important. That is what we call in candle signs a respect candle. Why is that a respect candle? What is actually the theory, the logic behind it? Well, that wick right there on a singular candle basis is just a wick. But what happened at that moment in time? Well, we opened up in that candle, we went higher, we went above the swing high, and then we came back down, creating that top wick right there. But what happens on the lower time frame? On the lower time frame, that is seen through fair value gaps. So we first had fair value gaps going higher, and then fair value gaps going lower. Actually doing what? Creating a reversal. So a respect candle like that actually is a reversal on the lower time frame. Means we are respecting a premium array to potentially continue lower off of. Now, the other candle that we talked about, the disrespect candle, is not that relevant in this case, but let's still cover it. A disrespect candle is simply when we also have an opposing PD array like this, that premium array, but we simply close above it. So we don't have that long wick at the top like we have with this swing high. In other words, we only have fair value gaps on the lower time frame pointing higher. They never come back down, meaning we can continue in that direction of the disrespect. So when we then use the replay tool right here and pay attention to the order, it's important to understand we first respect an opposing PD array right there before coming back into that PD array that we expect higher prices off of, that we are looking to confirm on the lower time frame with our entry confirmation. Meaning, first thing happens, we reach above that premium array right there. So we reach a premium array. We are respecting that premium array. We have a discount array that we might want to continue higher off of. So we want to confirm that on the lower time frame. But if we are respecting this premium array whilst coming back into the discount rate that we are expecting higher prices off of, that means that we automatically want more confirmation off of this discount rate right there. So the entry confirmation needs to be more, which is what we're going to go over in step 2. Now, this is the candle signs part, and let me give you a few more examples. Here on GU, the exact same thing happens. This daily fair value gap and this daily fair value gap as well. In both those daily fair value gaps, you would want to see more confirmation than usual. Why? If we actually zoom out and go to the weekly time frame, then on the weekly, we see that we are delivering into this weekly fair value gap right there, and we also actually have a breaker right there. And in both those scenarios, the weekly fair value gap and the weekly breaker are responsible for the retracement that gets created. In other words, we are respecting an opposing PD array right here, and whilst respecting those opposing PD arrays, we are retracing back into the premium arrays that we might want to see lower prices off of. And in both those scenarios, you will notice price is struggling to initially continue lower, but it does eventually continue lower, just like what we saw on gold. Price is struggling a little bit, but eventually it does continue higher. Now, it's very important to understand right there that yes, in hindsight here, it plays out. But in life situations, oftentimes people are going to take a few losses before they catch that winner. And we can all catch the winner every single time, I promise you. But how many losses are you catching before you take that winner? Because if we catch even, let's say 2 or 3 losses before we actually catch the winning trade that follows through, we are overall at a net loss. So we need to avoid the losses before the winner comes, which comes from extra confirmation. Now, we discussed more confirmation is going to be determined by 2 things, candle signs and fair value gaps. In the previous 2 examples, we discussed candle signs. Here on Australian dollar, US dollar, if we again have that discount rate that we want to continue higher off of, either the order block, either the fair value gap, does not really matter right there. But the more important part is that we have this swing high that we are respecting whilst creating the retracement back into the discount array. Now, that was the candle signs and we understood that. But now with that candle signs, if we also create on the same time frame a fair value gap coming back into the discount array that we are looking to confirm on the lower time frame, we need even more confirmation. Because now we have candle signs right there. So there's one argument that we might want to continue lower because we are respecting a premium array. And there's another argument we also created a bearish fair value gap right there. So that's double. So we want essentially double the confirmation right there if we still want to continue higher. So now we understand that thought process of seeing the market from both sides, because a lot of people go wrong when you only have this discount rate on your chart right there. But think about it like this. If we are going to continue lower, we are indeed going to sweep and respect that swing high to then actually create a bearish fair value gap as well, to then potentially continue lower. Does that mean we want to look at bearish prices? No, because the overall idea was still being bullish. It just means we want more confirmation. Now, before diving into step 2, let me also give you an example of a PD rate that doesn't need that extra confirmation. For example, right here, we are on crude oil and we are aiming for this high right there. We are not offering this fair value at this low right there to continue lower. We create breakaway gaps to continue higher. And on the 4 hour, if we find a discount rate to continue higher off of, we can see we have this 4 hour fair value gap right there. And doing all this, by the way, without respecting an opposing PD rate and without creating a fair value gap coming back into the PD rate. This leads us to the understanding that this fair value gap, or even the fair value gap higher as well, needs less confirmation, and we can just use the normal entry confirmation right there because the PD rate itself is already high probability. Now, I assume you're here to look for profitability as a trader. So if that's the case, then please listen to what I'm about to tell, because this is extremely important. You need to set your expectations right. When people learn about certain concepts, they think they can just use those concepts everywhere, which is not the case, because there's always a probability attached to that certain scenario. Meaning an ST, for example, sharp turn, is beautiful. It's very fancy. It looks very nice, but it's the bare minimum confirmation you are going to need. But if you, and which is most likely the case, you're not going to have that high probability PD rate to trade off of, you are going to need more confirmation. So what is more confirmation? More confirmation is anything above the baseline. So what is the baseline? Well, the baseline is your usual entry method. Meaning, if we look at the following time frames right here, then if we are talking about a monthly PD rate, we want to confirm that with a daily sharp turn. If we are looking at a weekly PD rate, we want to confirm that with a 4 hour sharp turn, a daily 1 hour sharp turn, a 4 hour 15-minute sharp turn, then the 1 hour 5-minute, and a 15-minute to 1 minute. And that right there is the baseline for sharp turns, meaning that's the bare minimum amount of confirmation we need. Anything above that is more confirmation. Anything below that is too little confirmation, meaning you don't want to go below that. You don't offer a daily fair value gap, a daily PD rate. You don't want to confirm it with a 15-minute sharp turn. It's never going to be enough. In hindsight, it might be beautiful. In real time, you're going to take a lot of losses. The 1 hour sharp turn is a perfect combination with a high probability daily PD rate. But if that daily PD rate is not as high probability as we expect it to be, according to the parameters in step number 1, then we understand we want more. So more confirmation above that 1 hour sharp turn. So what could that be? That could, for example, be a 4 hour sharp turn. Now, what does the sharp turn even look like? Let's first clarify that. Here we are looking at a 4 hour PD rate right there. And on the 15-minute, we also get a beautiful sharp turn right there. A sharp turn is the following. A sharp turn has a fair value gap coming into the PD rate that we are looking to confirm. And afterwards, it has a fair value gap going out of that PD rate as well. Now, as MMT members, you know there's quite some variables to understanding what a good sharp turn is and a bad sharp turn, etc. But for simplicity's sake, I'm just going to say right here, a sharp turn is, on the time frames we just discussed, a fair value gap coming into the PD rate that we are looking to confirm and a fair value gap going out of the PD rate. Those fair value gaps don't need to be overlapping as long as there's a fair value gap going in and a fair value gap going out. Then that sharp turn can be an entry of the first fair value gap, of the creation of the fair value gap, however you want to enter from that point on. Now, at this moment in time, we see the 15-minute sharp turn also plays out actually right here. But since this is a low probability PD rate on the 4 hour, we actually want to go into the 1 hour. So we want to go up a singular time frame to then confirm the sharp turn. And then right here, we get this fair value gap right there, which we can enter off of because now we have even more confirmation. Again, the closer the PD rate time frame and your entry confirmation time frame are to each other, the less confirmation you are going to need. Meaning, The PD rate time frame that we are looking to confirm is on the 4 hour. Then the entry time frame right here is on the 1 hour. There's no difference. You have the 4 hour and the 1 hour. You can only use maybe the 4 hour and the 4 hour. But in this case, you don't need a lot of confirmation. You might only need a fair value gap actually going higher. So when we talk about going up a time frame, the fair value gap coming in to the PD rate that we are looking to confirm, for example, here on the 1 hour, that's nice, but it's not necessary as long as we have that extra confirmation of the fair value gap going out right there off that PD rate. So here we get the perfect extra confirmation and we can still simply look to continue higher right there without having to worry if we might take a loss before that. Now, you might say the 15-minute sharp turn also played out. So why even use the extra confirmation? Again, that's confirmation bias because this is one singular example right here that I just simply used for the video. If you're also in the MMT, for example, in live sessions, we discuss very often how much confirmation you need, etc. So it's all upfront. It's not in hindsight. But to explain it more clearly, so at this moment in time, it's a scenario where we have a battle between this swing high right there that we are respecting and this fair value gap. Meaning, if we want to continue higher, this fair value gap will be respected. If we continue lower, this swing high will be respected. So when we have a respect of that opposing PD rate, we always want more confirmation because we might just be trading the top and we might just continue lower instead. Now here we have the Australian dollar US dollar situation where we not only had candle signs right there respecting an opposing PD rate, we also had a fair value gap created against us. So if we again look at the list, then we see off of a high probability daily PD rate, we only need a 1 hour sharp turn. Well, in this case, we already know based on candle signs, the previous example, we want to up that to a 4 hour sharp turn or at least a 4 hour fair value gap out of the daily PD rate that we are looking to confirm. But that's only if we had candle signs going against us because now we have two things going against us, the candle signs and that fair value gap. So what we mentioned earlier, we want double the confirmation. Now we know this discount rate is even lower probability potentially. So we not only want to have a 4 hour sharp turn, but out of that 4 hour sharp turn, also a new 4 hour fair value gap. What does that look like? If we dive into the 4 hour right here, then again, we have this daily fair value gap right there. We have the 4 hour sharp turn sitting quite low right there. That 4 hour sharp turn is not what we want to enter off of. We want to enter off the next fair value gap. So that is essentially this fair value gap right there can be of the creation of the fair value gap, can be whilst we sting into the fair value gap as well right there. And then we look to continue higher. And you can even confirm this through, right? So for example, in this case, this 4 hour sharp turn right here does not need to be your entry. It can also be the PD rate that you want to confirm again on the lower time frame. So here we have this 4 hour fair value gap, the opposing PD rate that we are respecting, going back into that 4 hour value gap that we might want to continue higher off of. We again want more confirmation to avoid price action where we consolidate and then after we take a loss, we take 2 losses and then we start to continue higher. Now let's understand this scenario right here that we had on crude oil where we had that target with this 4 hour fair value gap sitting right there. Now then seeing the highest probability scenario right here on crude oil where this PD rate is already in itself high probability, so we don't need extra confirmation. Then we can simply go into the 50-minute, the usual entry confirmation that we have and enter off of that 15-minute sharp turn that we have sitting right there. Which this, by the way, is a trade that I caught myself as well and we mentioned as well in the MMT live session. Just to show you that we also apply this in live. Since it's quite mechanical, we can also apply this in live. So what is the mechanical thought process behind it? Let's sum it up. In step number 1, we determined that if we are respecting an opposing PD rate based on that candle signs, then we want extra confirmation in our PD rate that we are looking to confirm. Now, let's call that mid probability right there. Then we have low probability, which was the second scenario, where we have candle signs and fair value gaps. So we have two things going against us essentially. When that happens, we want extra confirmation, the double confirmation. And then we had the high probability, where we don't have any of those scenarios. So we're not respecting an opposing PD rate. We also don't create a fair value gap going against us. So we have high probability, mid probability, and low probability. Then step number 2, confirmation, is the following. High probability, we just want to use the baseline. Mid probability, we want to go up a time frame to then use the entry. Low probability, we want that confirmation, so the sharp turn that we talked about on a time frame above us, like mid probability, but then also a new fair value gap out of that sharp turn. So this is the list. Take notes, take a screenshot, whatever you want to do. Again, if you don't use sharp turn entries, you can still use this in the following way. If, for example, you don't even use fair value gaps and you only use market structure shift, this is your market structure shift right there, and just wait for an extra market structure shift right there. So whatever your current entry is, everything above that, everything extra is extra confirmation. And that's exactly what you want to focus on when the conditions like that are met. All right, perfect. Thank you.